Thank you, everyone. It's a great pleasure to be here and talk about, actually continue the conversation that our investors had this morning about this great transition that we're having, the transition from the fossil age into the green age. There we go. Okay. So I always like to start our talk with the why of things. So I think our planet is undergoing a change in terms of its temperatures, and the policymakers are quite eager to slow that change down to make it as much more habitable for us as possible. And there was certainly a long history of cooperation, and most recently with the Paris Agreement, over 6,000 policies in effect, 198 countries in agreement. And most recently, the UN panel that coordinates all these efforts came out and said that the pace and the scale of our efforts is just not enough to tackle this climate change. And that picks up in part of the investment going into the metals is just not keeping pace as well. So we did continue, we began and will continue to retool for the green age, starting with how we generate energy, how we transport energy, how we store energy, and how we use this energy. This is what the global energy transition is all about. And we will need all new metals to feed into this, significant amounts of metal. Everything from copper, from zinc, from aluminum, from steel, from nickel, lithium in particular as well. One of the most evident displays of electrification or the changing of the society is electric vehicles. We anticipate that by the end of this decade, probably about half of us in this room and globally will be driving electric vehicle. And by the end of the next decade, in 2040s, most of us will. And this will be supported by a massive expansion in battery capacities to support this growth. Already we've had significant growth in gigafactories throughout the world, predominantly in China, but this will start to change with investment in North America and in Europe. And we see that by 2030s, Europe and North America will play this key hub of battery manufacturing. And the metals that we need for the battery are lithium, nickel, cobalt, manganese, and these metal intensities will continue to be optimized to manage cost. One thing to highlight here is the constant between the batteries, and that's lithium. One of the things that I was thinking about recently is today our analog to energy, rather our relation to energy, how we define energy is oil. But if we think about in the new age, what is this analog to energy? It's probably lithium. It is constant in every single battery, and it is unlikely to be replaced in the near future. In the battery itself, nickel will remain the dominant chemistry for some time. The nickel-rich batteries, which have been introduced particularly by Tesla with NCM batteries, are going to stay. However, LFP batteries, so the lithium iron phosphate batteries, will continue to play a role, and even with this blade technology in China, will continue to be optimized with regards to energy densities and packing in the car, such that they will continue to stay and represent a really good base of battery demand. We do have the sodium-ion battery at the very bottom of our projections. They are a new technology, very interesting, exciting in terms of their cost. However, they are heavier and bulkier than their lithium counterparts. So they will have most likely an application in stationary storage. And this energy transition represents a profound demand growth on all of these metals. So what I've shown here is the four, let's say, battery metals or transition metals: lithium, nickel, cobalt, and manganese. And this is demand just for batteries. To compare in terms of what it means for the batteries, and I'll read these numbers, I know they're a bit tiny here to project. For lithium, without this energy transition, we're seeing an annual growth rate of about 2.8%. With this energy transition, we're seeing that go up to about 11%. So energy transition is the defining trend for lithium. Nickel on the other side, 3.4% CAGR without energy transition and going up to about 5.5% with. So what that means is that similar to lithium, batteries is an important driver for nickel demand. The stainless steel application will continue to be there. but batteries, especially for nickel and high purity nickel sulfates, are going to be quite a big driver. Cobalt, on the other hand, less so. We see an improvement, slight improvement given the batteries, but cobalt, given that it is associated with some of the unethical mining in Africa, it's a bit of a blood cobalt, similar to blood diamond situation where sourcing and transparency in the sourcing of the cobalt are going to be critical in this. But talking with all the majors in terms of the OEMs, a lot of people are distancing themselves from cobalt as much as they can and favoring chemistries that minimize its use. Manganese, and particularly high purity manganese, incremental, not something to be dismissed, but also an important driver for manganese demand. We have a panel on copper coming up, so I added a lot more, let's say, content on copper specifically in terms of demand and supply. And just to kind of go back to each of these metals will have their own dynamics with regards to how much supply is needed, what the gap over the next decade and 2 decades is, and what the costs are to bring production into play. For copper, the energy transition breathes new life. Without this energy transition, we're seeing a very lukewarm growth in demand. With the energy transition, we're increasing that to 1.1% CAGR. Copper here is needed for not just electric vehicles and the wiring in the car, but also in the infrastructure, the charging, and so on, and also the renewable. So in particular, the winding of the motors and so on. And our analysts are anticipating that the amount of copper that is in the car itself will go down over time as we find efficiencies in its use and research in terms of thinning the foils in the car and increasing the amps versus the voltage to reduce the size of the wire itself. So much so that maybe by the end of the several decades from now, we're going to see the amount of copper in the car be a little bit higher than the current models of petrol vehicles, but still a little bit above. And when we look at copper, and I think this morning's conversation with regards to the amount of investment required and the attrition that we see in the copper space will make this requirement for copper much higher, or rather much more challenging. The grades are declining. We're going deeper. And that's the attrition. On top of the demand that we're seeing in terms of the growth, we'll need about $120 billion over the next 10 years to invest. And I think one of the esteemed panelists early in the morning had highlighted the paper from McKinsey saying that we're completely behind the investment into these mines. And I'll touch upon that because that is a peculiar case for the Western supply chains. In terms of capital intensity by projects, these are increasing, not just because we're in an inflationary cycle, but because the availability of engineers and the goods to make these projects is becoming more challenging. So paired with this inflationary cycle that we're seeing, this you can see these curves are kind of steeping up. We're likely to see more of these cost escalation. So this requirement is just going to increase. So when we marry supply and demand together, we're trying to find what is this incentive price needed to close that gap. The way our team does this is they look at every single project that's been announced, looking at all the technical stats in terms of grade, location, depth, strip ratios, and so on, to calculate the break-even cost for that project. So in the world of copper, in terms of closing that 7 million ton gap on copper demand, we'll need around $8,000 per ton price. A lot of things go into this, and there's a lot of variability in terms of the assumptions made. And I looked at our team's assessment over the last 5 years, and that long-term price varied plus minus $500, $700 per ton. So fairly consistent in terms of the expectations. And what's exciting is that the field is wide open for investment and development, particularly for a panel like this, all the interesting projects. So what we've done here was we've taken a look at these projects that are below the incentive price that we indicated and said, well, who owns these projects and where they are. And the beauty of it is that a lot of these projects are in the hands of juniors who you are talking with today. And in terms of their location, certainly we do see the concentration in South and Central America and Africa, which is the traditional camps, but we also see in other parts of the world just as attractive positions in copper as everywhere else. Normally a talk would end here. However, there's an interesting dynamic emerging as well, and that is the competition for these critical metals. Our world is changing. If those who aren't paying attention really should be paying attention, a lot of conflict, a lot of tension with regards to access to these critical minerals. Just the other day, China banned or restricted the export of graphite, which is, they are supplied about 80%, which is needed for these battery metals, or rather the battery itself. I'm just going to read this here because I think it's important to reflect on it. So this is President Xi saying to us, really, that right now there's changes, the likes of which we haven't seen for 100 years. And we, meaning the BRICS nations, are the ones driving these changes together. I think this is probably the first time in a very long time we in the West are not in the driver's seat when it comes to this change. And that is an interesting prospect to get our head around. And this competition to secure the materials is just going to intensify. We looked at so pretty much every economic bloc has done an assessment of what is critical for their energy transition. And they've listed pretty much every metal as critical. One has to wonder, if everything is so critical, what is? So I think one of the panelists probably highlighted, what do we need to focus on to drive some of the investment that we need? And I'll there's a report by OECD more recently just highlights some of the observations we made, in that the export restrictions on these critical raw materials have seen a 5-fold increase since they began measuring this data in 2009. And copper most recently was added to just on the DOE in terms of their criticality. China has been very busy over the last decade with the Belt and Road Initiative. And investors this morning kind of highlighted as well that to get anything, you need to go to China. So if you look at lithium mining, cobalt mining, nickel mining, they started low, but they're increasing their position in terms of equity ownership, most recently with Zambia investment for lithium. In terms of refining, dominant position. And that translates down to CAM, cell, and certainly EVs. And this has allowed China to leapfrog the West in terms of manufacturing EVs. So they are now the largest manufacturer by a large margin, and also increasingly exporting their cars to the globe. And I think if we want to go back to this slide here in terms of competition to secure these supply chains, and talk a bit about graphite, and it's very strategic for them in that with the restrictions to graphite, they've in essence ring-fenced their value-add activities. And this will only continue. There is capacity in the West to build, but it is more expensive than in China, significantly more expensive. However, our governments and our, let's say, trading blocs are not idle. They kickstarted this Inflation Reduction Act that the panels talked about earlier this morning, and the European Union as well with the Green New Deal. Both are aimed at bringing significant capital to bear for the supply of these critical materials to flow into these regions. And one of the critical things that the value chains in the West need to ask themselves, and particularly the OEMs, is how much of my supply chain is exposed to this new geopolitical risk? And how much can I tolerate that? And this is why, let's say, I think you mentioned earlier this morning with regards to the non-traditional investor coming into the table, the OEMs, the Apples, and so on, because for them, it's becoming an existential threat to their business, and it's becoming intolerable. Another thing to mention here is carbon pricing. carbon pricing may increasingly become mechanism of pressure rather than the stick. So the IRA and the Green Deal is a nice carrot. There is the existential threat to the planet that may or may not be, the urgency that we feel, because we tend to think in short term as humans. But this carbon pricing, I do believe, is going to become the stick to encourage change. Our team does a lot of work with regards to in the sustainability space and predicting what the carbon pricing is going to be based on abatement cost. So our team predicts that certainly this carbon price is going to be increasing significantly relative to what it is today, especially if we are looking to do more on the climate change than today. And just going back to what I said earlier, and that is that the pace of change that we are undergoing is not enough. So I do think that stick is going to become a bat eventually. And this is across all the major economic regions, including China. A couple of decades, their pricing is going to go up. And these emissions are going to be an important competitive advantage for companies as they rank themselves on this emissions curve relative to the competitors. And increasingly, we're seeing in the market a desire to monetize this differential in the form of a green premium. And I think that that's something that's going to become play an important role when you as investors are looking for investments in juniors and those that are operating today when they deal with their customers. So in conclusion, new value anchors are emerging to accelerate the pace of transition. There is the carrot, there is the stick, there's the existential crisis of the planet, and the existential crisis of the value chains. The world is becoming increasingly unknown, but in that there's a lot of opportunity to invest, to find new pockets of value. And the metals that we need to support this transition are enormous in scale. And whether we hit those targets will depend on whether mining is able to deliver the metals or whether these metals will be substituted out with new technologies. So it is for the mining sector to lose this opportunity. Thank you. Happy to take questions. Yeah.
Copper, one of the most important metals in the world. Is there going to be a lack of investment there? And is there a need for copper?
Well, I would say technically there's no peak in copper because there's lots of deposits, lots of projects that can be activated at a certain price point. So when we say peak copper, if we do nothing, yes, there is, because ores will deplete, grades will go down, and there's a natural attrition to the mines that operate. But with the right price point, as you can see here, with the right price, we can produce a lot of copper.
Any question about carbon and the stick there?
Yeah.
Does the U.S. have to adopt carbon tax?
I would say that more people need to adopt it, because if just Europe is alone, that becomes a detriment to do business in Europe, and people will do it elsewhere. So it needs to be a unified front for that to be effective. Europe, one of the biggest European exports is regulation, so I think that they will probably be successful in that.
Is that realistic to expect the U.S. to adopt?
Really good question. What do you think? I think given the competition between the two nations, I would be hard pressed. They will have to come together in the interest of the planet to do that in some sort of a joint declaration that this is how it's going to be. But it's going to be whoever blinks first is going to have a disadvantage relative to the other ones for a little while before the other ones introduce a carbon tax or carbon price.
I really appreciated your presentation, very compelling. Given you put forward such a compelling case about copper, why isn't the market more active? Why aren't investors falling all over this?
Good question. My only, let's say, fallback on this, because you're right, the narrative is very strong. We need copper. You wonder how come nobody's pouring a lot of money to invest in. I worked for 20 years. I worked for a major, so my career is with Vale, and I'll tell you personally, we got burnt a lot. Vale got burnt a lot with huge capital projects that we ended up selling cents on a dollar. So I think there's still a lot of insecurity when it comes to bringing these big spend projects onto the market. I think you also very astutely mentioned that majors want to buy existing mines, but that's just doesn't add anything new to the table. So
So when you quote an $8,000 incentive price, does that include that risk, the market risk perception of, is 8,000 enough? It seems very low to me. Because people like Barley would say, well, I need to get like a 50% return on this to put money into it. So
That's right.
Is 8,000. Does it include that risk adjustment?
Good question. I don't think it really does. The way we do these things, we have a WACC, let's say, and let's say, adjust based on project probabilities in terms of how much it will be. But I do think that 8,000 feels low, but given that a lot of the copper production, let's say, costs are well below that, there's a big margin to be made still.
Yeah, you say that given a certain price, whatever that price is, it will open the floodgates and you will have all the copper you need. But when would that happen, and how would you get there? Since it takes 6 to 12 years to actually start a mine and get it into production.
Yeah. So my reference is the super cycle that we had. So the super cycle, in essence, gave us that huge price boost suddenly, given that the horizon of Chinese demand was so great, right? So if we can use that as a parallel, it'll probably be once we realize the gap and the pace is a disconnect, there's going to be this price appreciation. We could enter another super cycle potentially, right? Especially if we have this massive investment coming in, massive requirements coming in, and a lot of hungry customers looking for product. So that will kind of push that into it. I think there's a lot of projects which are are staying warm exactly for that reason. So what that price is, I'm not sure. I mean, our projections over the next couple of years is for the price to go significantly higher than what it is today. So maybe that kind of the next 5 years, when we see this appreciation, we'll see that kind of investment going. Because I agree, 8,000 is the break-even cost, not necessarily, hey, I'll come in and invest at that price point. But it's going to be maybe 12,000 copper, which we do see coming over the next couple of years. That's something that's going to be, and that's probably the highest copper has been. It's going to be, okay, well, that's the price point where I'm going to start seeing some more capital flow in. But I agree, the more we delay, the greater that that point of closing the gap is kind of escaping us more and more and more.
Given the geopolitical landscape of 2 wars and potential for more, do you foresee governments securing these mines or having a company as a proxy to secure these supplies? Or is it going to be the auto companies, which could arguably be a government themselves, to secure their resources?
Great question. I see it as a mix of both. We do see resource nationalism and the desire to retain as much value add as possible. We've seen that play out in Indonesia, where they opened this up to nickel mining, massive nickel mining, and now they're looking to refine chemicals, and eventually they're asking for the EVs to be assembled there. So I do think that this also represents, from a national perspective, opportunity to enrich what typically is maybe a poor segment of the planet. I do see OEMs coming in as a necessity to secure, because if you don't have the raw materials, you can't build a car. So if you think today that I'm a major OEM, tomorrow I'm not going to be, because everybody's going to be driving a Chinese car, and I can't compete because I don't have the metals to build these things. The world has really changed. And that change, either you're on top of it and you can anticipate what you need to do, or it's going to be too late for you and you're going to become delegated to a small player in this space. So we could see a churning of the whole automotive industry, because we saw Tesla suddenly become one of the biggest ones on the planet. They came out of nowhere, we could see a churn where what we saw yesterday as being these big players become small, maybe niche players in luxury markets. We'll have to see. But we'll have to see how it develops. I see both playing out. Maybe needs to both play out for us to do that. Thank you so much.